Good morning and welcome to Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'll be your host here for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. But before we get into what we might see ahead, let's take a look at a little bit of what happened yesterday. Here is the candle glance chart of some of the major indices around the world. You can see the Dow Jones Industrial Average took a pretty big hit yesterday, as did all of the major indices here in the U.S. Looking around the globe, we saw a lot of selling as well elsewhere. Perhaps the biggest news was the economic report that came out that showed manufacturing data. It was the ISM Manufacturing Index. Came out yesterday morning at about 10 a.m., and it was very weak. Came in at 47.9. The market was expecting 50. Really hard to sugarcoat it. I mean, the manufacturing sector is definitely slowing. Here in the U.S., we've seen tremendous slowdown in Europe. Germany has had some pretty low readings the last few months, and it seems like some of it's being imported into the U.S. The export area of the ISM number was extremely low, came in around 41. And if you're unfamiliar with that report, anything below 50 signals contraction. So the fact we came in with an overall number at 47.9, that's pretty slow. Definitely showing that the economic activity is slowing, especially in our factories. But the big number was the fact that the exports had slowed so significantly, and that I think is relating quite a bit to what's been going on with the trade war and what a lot of other countries have been experiencing. The one thing that I would take out of this is that I believe we are going to see additional rate cuts here in the U.S. And it makes sense. I mean, the dollar's been strong. You don't want the dollar to continue to strengthen. So if we don't cut and everyone else around the globe is cutting, it's going to strengthen our dollar. It's going to drive commodity prices lower. It's going to drive inflation numbers lower. They're already below target level, so that results in disinflation, meaning that it's just moving lower. Still inflationary. We still have positive numbers, but moving lower. I think that this all sets up for the Fed to lower. I thought they should have lowered 50 basis points at the last meeting. There was one Fed voting member that did vote for a 50 basis point reduction. I don't know what we'll see in the next quarter, but I would based on what I saw yesterday, I think we will get at least another quarter point cut when the Fed meets again. All right, let's take a look at the 10-year Treasury yield. And I have a chart here that discusses the 10-year Treasury yield on a weekly basis going back the last 10 years. So this is throughout the bull market. Here's the S&P 500 making its move throughout the bull market to the upside. And then down at the bottom is a correlation. And this correlation just tells us how correlated these two are, the 10-year Treasury yield and the S&P 500. When you get readings up at 1, it means that they're positively correlated, meaning that when the 10-year Treasury yield goes up, the S&P 500 goes up. When they go down to -1, means that they're inversely correlated. So when the 10-year Treasury yield's going up, the S&P 500 is going down. Now, what I take away from this chart, just looking over the last 10 years, is that there is no true perfect positive correlation here, but it is mostly positively correlated, meaning that when the 10-year Treasury yield goes up, and if you think about it from a common sense perspective, when the yield's going up, it means Treasury prices are coming down. There's always an inverse relationship between Treasury prices and Treasury yields. So if the Treasury yield is going up, it means money's coming out of Treasuries. It's coming out of a defensive asset class. Normally what that means, and the reason that happens, is something good is going on with the economy, or the market is simply anticipating something good is going to happen with the economy. And if that's the case, then you want to be in equities. As the economy expands, corporations do more business, they boost their bottom lines, the PE multiples expand, and the S&P 500 goes higher. So taking a look at this, you can see that we have had, over the last 10 years, several instances where we've gotten close to 1, meaning that we've had pretty positive correlation between the 10-year Treasury yield and the S&P 500. Only a few times have we gone down below minus 0.50. So I think looking at this chart, you can see that there's definitely a correlation between the two, a positive correlation between the two most of the time, not all the time. And there are reasons for that. When you have a 10-year Treasury yield that's going down, that means money is going into Treasuries. The S&P 500 can still go higher. I mean, if you look back in 2011, when this 10-year Treasury yield was dropping, we did make new highs periodically in the S&P 500. And you can see the correlation was kind of not really sure what to do. It would go in negative territory, then it would bounce back and so forth. There's always new money coming into the market. So you've got two things that impact the 10-year Treasury, well, the Treasury market, Treasury prices, and equity prices. You've got the rotation between the two, where portfolio managers are saying, hey, I want to up my exposure to equities. I want to lower my exposure to bonds. That's one thing that can drive this relationship, simply rotating. Another thing that drives it, though, is new money coming in. So the money that's there, let's say more of it goes toward treasuries. That drives the Treasury yield down as Treasury prices go up. But let's say during this period, there's a lot more money coming in from the sidelines. Remember, 2011, 2012 was after the bear market, and a lot of money had moved to the sidelines. So while the Treasury yield was going down, there was still money flowing into the market and allowed the S&P 500 to go higher. So you just have to understand this relationship. Now, as you look at this chart, a couple things stand out to me. When we are in a big downtrend in the Treasury yield, and you can look at it here back in 2010, when the Treasury yield was dropping pretty rapidly, what happened to the S&P 500? Kind of just went sideways, didn't really do much. How about when we had this big drop in 2011 into the first half of 2012? Well, right here, we were sitting at about 1375 probably on the S&P 500, maybe 1350, I don't know. By the end of the period, we still were up under 1400. Hadn't gone anywhere while that yield is dropping. Now look at what happens when the yield goes back higher. So here, middle of 2012 through the end of 2013, money is rotating out of Treasuries, sending the yield higher. And where's that money going? It's going into the S&P 500. From this low, we were down at about 1250, and a little bit more than a year and a half later, the S&P 500 was up at 1800. So 550 points on 1250. What's that? 45%? Pretty good move in 18 months. But then what happens? For the next 2.5 years, the 10-year Treasury yield, we had some ups, but for the most part, we were declining. From this point all the way over to the bottom of this decline, what did the S&P 500 do? Not a whole lot. 1,800 to maybe a little over 2,000. So in 2.5 years, it went up 10%. But then look what happens in the middle of 2016 when the yield takes off. See a big difference? The yield goes from 1.35% up to 3.25%. And during that period, the S&P 500 goes from 2,000 up to almost 3,000. So again, almost a 50% increase. Right now, the problem we've had in the stock market really for the past 2 years or 20 months has been the yield continues dropping. And, there are probably a couple of different reasons for it, but one certainly is that, economic growth is a concern. We're worried a little bit about what's going on around the world and the fact that we could import some of that slowdown, which is beginning to show up a little bit in our manufacturing. And so during this period, while money is rotating into treasuries, getting very defensive, our S&P 500 really from right here, we've gone nowhere for the last year. Now there's been a lot of fear. There's been a lot of rallies, but there's been more fear, more rallies, more fear. I mean, the news is all out there. But when you look at this long-term picture, when that 10-year Treasury yield is declining like this, we shouldn't expect a whole lot out of the S&P 500. The good news is we're getting close to a pretty key area of support on the 10-year Treasury yield. Nothing saying that we can't go lower. We may go lower, but I do think that what we have seen so far is that area around 135, 140 has marked bottoms. And if it does again, I mean, we may continue to move a little bit lower here, and we might see the S&P 500 pull back. I believe we're going a lot higher on the S&P 500, but I don't know that it's going to happen this month. I think it's going to happen in the fourth quarter with earnings, but if we continue to get economic reports out like we did this morning, it's going to spook the market. It's going to send money pouring into the treasuries, sending yields lower. And we already know, based on this 10-year history, just looking at this bull market, what happens when money is rotating into defensive areas. The stock market churns. And so we've got to be a little bit careful here in expecting too much until we begin to see that 10-year Treasury yield spike and really trend higher. I think we need to get back up above that 190 level for that to happen. We closed yesterday at 164. Got a lot of work to do still. All right. Let's take a look. Before I get into, I want to look at a long, big picture on the S&P 500. But before I do that, I'm going to go into the sectors yesterday, because as the selling unfolded, we did see more and more money shift into defensive sectors. That comes up pretty clear looking at this chart from yesterday. It's a sector summary chart showing utilities went down, consumer staples went down, but these two outperformed. These are two of the defensive groups. Look at their scooter ranks. If I sort these by scooter, utilities, consumer staples, real estate lead. Why? Same reason treasuries are leading. Same reason treasuries are being bought. Money is just defensive right now. We need to see things become, if we're going to get the targets that I'm expecting on the S&P 500, we need to begin to see the market act much more aggressively. Money needs to come rotating out of treasury, sending yields higher. We need to see money rotating into the into the aggressive areas. Some of these aggressive areas don't look bad on their own chart. I mean, if we pull up the technology ETF, the XLK, I mean, this is just a 6-month chart, but we got higher highs, higher lows, a lot of consolidation, big down day yesterday, but so far holding on to recent support. If I go out and we take a look at a weekly chart, last 3 years, again, I think you can see technology, perhaps the most aggressive. I would say technology along with consumer discretionary are the two most aggressive sectors. Parts of communication services probably could be thrown in there as well. But these are, these groups are continuing still to perform well on an absolute basis. It's not like money is, we're seeing a lot of selling take place in these areas. So I would be a little patient with the market. I wouldn't grow overly negative, even though we had another big drop yesterday with that manufacturing report coming out. There's a huge drop in the S&P yields, which were up, 6 basis points or something earlier in the day, fell 10 later in the day. I mean, it was a big reversal, but the numbers were not good. I mean, you can't sugarcoat those numbers, but that doesn't change my long-term view of the market. So let's take a look. First, before I get into that big picture view, let me pull up the candle glance on the sectors. And you can see all the red candles, but you can really see them on the industrials. I mean, that makes sense with manufacturing data coming out. Also with the financials, that makes sense because the 10-year Treasury yield got hit. Financials tend to perform well when the yield's rising. When the yield goes down like that, financials is one of the first areas to sell off. So the way the market reacted to yesterday's news, I think was kind of what I would have expected had I known that news was going to come out. Everything really got hit, but defensive groups held up better. Energy and materials kind of trade on their own, but both of them I think are going to struggle as long as the dollar is strong. That's been the theme for the last 8 years. Dollar's been rising, been in an uptrend since 2011. And on a relative basis, energy and materials have been underperforming the S&P 500 since 2011. So it's not really a shock there. So overall, I still think we're fine in the market. I don't like the big move down. I was hoping we'd get that breakout heading into earnings. Maybe we still will. But here's the big chart. Here's the long-term picture. And this is what has me still thinking very bullishly. It's going to take a lot to be honest. It's not going to be one economic report. It's not going to be one down day on the Dow for 300 points. It's going to change my opinion. I believe in these long-term secular themes. And I think that what happens is it's just like anything else. It's like regulations in the U.S. We become overregulated to the point where it just completely cuts off our ability to grow. And then we go too far in the other direction. We deregulate too far to the point where greed and excess is set in, and then we start regulating again. Well, when you look at the stock market, over time, it's that back and forth that really drives equity prices. It's just, when you think about the key drivers to the stock market, what I think about is policy statement from the Fed. What are they doing? What is the landscape for the business environment? And earnings. I mean, bottom lines. That's what drives the S&P 500. The S&P 500 is comprised of 500 of the largest multinational companies in the world. When their earnings are going up, the S&P 500 is going to go up. When their earnings are stagnating or going down, the S&P is going to go down. But a lot of that is also dictated by the business environment. So that's why I think we have to pay attention to what the Fed's doing. Now, some will say, well, the Fed's cutting. That's not good. That means the economy's weak. Well, it means that the economy's sputtering. I wouldn't say that the economy's weak. We did just have the ADP employment report out today. 135,000 new jobs added. This is a little bit of a precursor to the non-farm payrolls. I pay more attention to the Friday report, so we'll see what happens there. But in order to have a recession, you need to have negative jobs. You can't keep showing job growth and have a big bear market and recession. Just doesn't happen that way. But looking at this chart, this is a 100-year chart on the S&P 500, and it's a monthly chart. And what we do is we go through periods. We go through secular bear markets. We go through secular bull markets. And when you're looking at these red shaded areas are secular bear markets. It doesn't mean that you go down for 12 or 14 years. It just means that you have some really ugly stuff going on for a while, and the market goes nowhere. Now, it doesn't mean that our economy's not growing. It doesn't mean that we're not more innovative during these periods. It's not any of that. It's just catch-up time. Usually, these cyclical bear markets occur after secular bull markets, where things just get overdone for a long period of time. So when you look back at the 30s and into the 40s, you can see all this sideways ugliness. I mean, we had some big sell-offs, cyclical bull markets within the secular bear market, and then more selling, and then another cyclical bull market, then one more pullback, and then we break out. And then we have what I view right here is about an 18-year, 19-year secular bull market. Then we go into a dozen years of secular bear market. Then another 18, 19 years of secular bull market, followed by 12 to 13 years of secular bear market. And I believe in 2013, when we made that breakout, we're starting what I think is going to be another one of these 18, 19-year secular bull markets. Now, it doesn't mean we're not going to have bad news. It doesn't mean we're not going to have sell-offs. It doesn't mean we're not going to have bear markets, but they're going to be cyclical bear markets, in my opinion. When you get a cyclical bear market, look at 1987, the market crash. That was a cyclical bear market. 1990, we had a cyclical bear market. 1998 barely even shows up here, but we had a cyclical bear market, 20% drop. It looks like when you're looking at these long-term monthly charts, we never really pulled back much. But if you were trading or you were investing during those times, they were scary. Anytime you see the market pull back 20% in a period of a few months, that can be pretty scary. Your retirement accounts going down, trading accounts, going down. That can be a rough period unless, of course, you're shorting, which I don't think is a good strategy in a secular bull market, but to each his or her own. Couple things to look at, though, when you're looking at these long-term charts. Notice the blue shaded areas on the PPO. When we're in a secular bull market, we stay above that center line on the monthly PPO. We're still above that center line. So we can talk about recessions, and I kind of joke about it. CNBC, I think, has already called 6 recessions this year. Um, that's just what's going to happen. Every time we get a bad report, every time we get a pullback in the market, it's a recession. It's the inverted yield curve. It's the trade war. It's imported slowdown from, overseas. It's whatever. You pick something. It's the FANG stocks not performing as well. There's a reason. There's always a reason. But every few months, it seems like we're getting another recession call. Look at the numbers. The stock market's the best leading economic indicator, the best. So as long as you've got a positive monthly PPO, the market's looking forward, momentum is still above zero, I wouldn't worry too much about bear markets, certainly not secular bear markets. Now, these red dotted lines here on this chart show you after long, lengthy periods of rallies. Of course, we didn't go back before 24 here, 1924, but we had a huge rally here. We had a huge rally here. We had a huge rally here. And then we went negative on the monthly PPO. And if you're kind of watching and you're seeing that this developing, this was a very early period to get out in a secular bear market. All three of these. So I'm not going to sit here and try to worry about every time the stock market goes down in what I believe is a secular bull market. If we start to roll over and the PPO goes negative, this monthly PPO goes negative, then it's time, yes, to sit down and figure out, okay, what's going on? We've had a few scares. Back here in 1983, we did go negative, but we had just started the secular bull market. We had just broken out to our first high. That was not a mature bull market. It would have been very unlikely to see a 12-year bear market, a 2-year bull market, and then go back into another bear market, especially a secular bear market. And there were a couple of others where we got down to the center line, or maybe just slightly below before we turned back to the upside. So there may have been some scares. But again, these were a little bit later in the period. We're not near the center line. We got a lot more room to go. Anyway, I spent a lot of time on that, but this is pretty important to me because big picture, I've got to try to develop my trading strategies and investing strategies based on what I see big picture. And I can't react every time we have a bad report or CNBC gets on their high horse and wants to start parading in all of their bear experts. Peter Schiff, who's been, I'll just say it, the biggest loser since about 2011, scaring people to death since we moved into this bull market, continually talking about how everything's going to fall apart every time he's on CNBC. Look at the numbers. Look at the charts. Let the charts be your guide, especially these long-term charts. All right, let's see. What else do we have here today? Well, I want to go over a couple of earnings reports. So let's go ahead and pull up the first one, which is, well, let's start with Lennar. Lennar had a really nice report, and it is in the home building space. I'm going to pull it up on a relative chart. Lennar beat on their top line, crushed on their bottom line, $1.59 versus $1.32. Was looking, last time I saw, of course, this was probably 20 minutes ago, looked like it was going to gap up about 3% based on pre-market prices. It did break out recently. I mentioned yesterday on on Trading Places Live over at Stock Charts TV that this is not one of my favorites in the home building group. And you can see we're on a relative basis, this has not been a very good performer. I think you could do much, much better with many of the other home builders, but it's been a strong group. If you look down here, look at the home builders relative to the S&P 500, making a huge breakout there. That I think is really, really important. Let's go on to another earnings report. This is going to be UNFI, United Natural Foods. Now, the group has been performing pretty well. And on a relative basis, the group had been performing relatively well. But look at UNFI. I always talk about you want to be in leaders. It did show about 2 weeks of relative strength here. But I would say that the overall trend clearly has been down, and it's actually started rolling over again even before the earnings report came out. It was dismal. UNFI missed on their top line. Bottom line, 44 cents. The market was expecting 69 cents. 44 cents. Stock is down 19% in pre-market today. Stay away from these stocks that are downtrending on a relative basis. You do not want to be in relative laggards. There is a reason why Wall Street is selling these companies. You want to be in companies that are showing relative strength. All right, let's go on and look at LNDC. This is Landec Corp. This one was a little bit of a surprise because they did have mostly downtrending relative strength, although they came up in September. Actually, it came up for a few months here. But still, overall, I wouldn't have been trusting it. Volume picking up on the way back down. Not a big volume stock, so I'd be a little careful there. But Landec definitely came out with better than, I guess, what most people were expecting. Big beat on the top line. They just matched on the bottom line, 16-cent loss, which is what the market was expecting. But overall, not a bad report. Stock, I think, was up 2% in pre-market. I'm not sure that's going to last. We shall see about that. And that's basically what I wanted to go over with the earnings. There was an upgrade, or excuse me, a downgrade today, which is ATVI. It was just one that I happened to note. I'm sure there were plenty of others. But you can see ATVI in the internet space, internet breaking out here to new highs on a relative basis. Internet's been downtrending, but overall, I would say throughout 2019, mostly been a little bit higher. ATVI has not. ATVI was in a downtrend, just kind of going sideways, starting to strengthen a little bit. The downgrade will not help, but we want to see if it can hold $50 on any kind of a pullback. To me, if it loses 50, that was resistance coming across here. The 50-day moving average is just above that level. I think we want to be a little careful there. All right, one thing I like to do to end my shows is I like to do 3 you must see. So 3 charts going into the day that I think are worth looking at. One of them I just showed you right here, Activision Blizzard. The fact that it's being downgraded, it came up, broke out above all this resistance. Let's see whether or not that downtrend or whether that downgrade forces ATVI to break down below $50 or whether or not it holds. I would bet that it holds at least temporarily, but if it does break down below 50, I would be careful. Second stock I want to watch, Twitter. Another one in the internet space. It has broken down below its 20 and 50-day moving average, but I do think it has been a leader versus the internet space. And if the market rallies, this is one I want to keep an eye on. I do think that this is a key area, though. This is your gap support from earnings back in July. Notice the 2 pullbacks here right to 40. I think I saw in pre-market action today, $39.99. So we are getting really close to a key area of support right here on Twitter. I mean, if it breaks down, who's to say? Maybe it goes back down to 38 to test that prior. We do have a trend line that we want to kind of keep an eye on as well. So if we go down to this December low, which was important, the late June low, which is important, notice where that comes in. Very close to where we're trading right now. So if we go down to 38, then it starts to paint a little bit more bearish picture because it doesn't hold this trend line. Turning at 40, on the other hand, would be very bullish. So watch for a possible reversing candle here. And then finally, the last one, if you weren't here earlier when I went over it, let me just pull up the chart that I had on the S&P. This was that big picture chart. I just think we're in the long-term secular bull market. So as long as we continue to move like this to the upside and stay with a monthly PPO in positive territory. Look at the RSI. Secular bull markets tend to stay, monthly RSI tends to stay above 40. When you go much below that, you start looking at secular bear markets. So I think this is a chart we really want to pay attention to as well. All right. Well, I do want to thank you for joining me today. Please remember, Mondays and Wednesdays, we'll be doing this here at earningsbeats.com, Trading Places Live. Tuesdays and Thursdays, I'll be doing it over at Stock Charts TV. Every day, though, Monday through Thursday, 9 o'clock to 9:30 Eastern Standard Time. Remember to get it on your calendar and check it out each day. If you have any comments, I'd love to hear from you. You can send me a comment at tom@earningsbeats.com. Also, you can still reach me, tom@stockcharts.com. Both would be welcome. Love to hear from you, and look forward to doing the show again tomorrow over at Stock Charts. So join me if you can. Everybody have a great day. Happy trading.